There are only two things that are guaranteed in life: death and taxes. Sadly, just about everyone fears both equally. I'm a major nerd and actually thoroughly enjoy tax. It's really cool to see how it works and how you can actually save a load of money if you play your cards right. So, how will you be taxed on the income you earn? First, we have to break them up into income sources. The first one, let's say interest of $100. Any interest you earn, so let's say a savings account, interest on bonds, is treated the same as your employment income, which means you'll pay tax on all of it. Now, when I say pay tax on all of it, I mean it is all taxable, but you obviously don't pay all of it in tax. There's a minor difference there. Essentially, the way tax works is the more you make, the more tax you pay on that additional income. So for example, anyone who earns more than about $200,000 pays about 50% in tax on income above $200,000. But students who always complain about how broke they are pay only about 25% on all their income because they are in a lower tax bracket. As you move up in brackets, note that only the additional income in that bracket is taxed at a higher rate, not at everything below it. It's everything below it is taxed the same as everyone who's making income at that level. So let's keep all these examples simple and say you pay 30% on all your income. So in this case, you pay $30 and keep 70 because you made 100, you're paying 30. At the end of the day, you get to pocket $70. Next, let's move on to capital gains. So capital gains are the increase in a share price. So if let's say you bought a stock for $500 and sold it for $600. So you now have a capital gain of $100. Congrats. Of that $100, only 50% of it is taxable. So really only $50 gets added to your income. So then applying a 30% rate from before, you'd pay about $15 in tax and pocket $85. A bit more there. Last, let's move on to dividends. So although they might feel like interest, they're actually different. I won't go into the accounting differences or the different types of dividends that you can receive, but essentially these are fully taxable as well, but you get a little bit of a tax credit, like a little bit of savings. In any case, you'll pay less on dividend income than you would on interest or employment income, but due to some complex like tax math, you'll either pay less tax on dividends than capital gains or more tax on dividends than capital gains if you earn upwards of like $100,000 a year. So if you earn less than $50,000 a year, you actually don't even pay any tax on dividends, which is pretty sweet. So let's actually just continue with the examples of saying you make $100 in dividends. You can expect, depending on how much money you make, to pocket about $85 again. As a reminder, if any of this income is earned in a TFSA, RRSP, or an RESP, then no tax is paid at all. And I know I can already hear my tax profs watching this video yelling at YouTube about all the stuff I left out. I know I left out a lot, but I hope everyone now has a basic understanding of how taxation works.